If you've been trying to understand whether the current supply disruption associated with transportation fuels and chemicals coming out of the Middle East and whether this has lent more support for active planned capital investments currently being tracked within European chemicals and transportation fuels, then this conversation will help you connect the dots. Welcome to Navigating the Currents of Change. My name is Shaheen Chohan, and I lead market analytics at Industrial Info Resources, a global provider of energy and industrial infrastructure market intelligence for more than 40 years. In our podcast, we will take a closer look at some of the key themes and trends being seen as Europe continues to forge ahead with its goal of decarbonising the transportation and chemical sectors. And to help me dissect some of these, I am delighted to be joined by Jean-Baptiste Mauduit, who leads our European research for alternative fuels and chemical processing. Welcome, Baptiste.
Very nice to see you, Shaheen.
All of our analysis and discussion points covered today are according to Industrial Info Resources data and is sourced from our global market intelligence project database. Now, Baptiste, if we could just kick off the discussion by talking a little bit about market sentiment, clearly at a time when the petrochemical sector in particular has been a little oversupplied, and clearly we're seeing a lot of price volatility, supply disruptions for many of the feedstocks required by the chemical sector. What is the general sentiment? And are we seeing the industry, is it in a phase of kind of capacity expansion? Is it sort of a period of stabilization, or is it indeed, unfortunately, in a state of contraction?
As you can guess, Shaheen, at the moment, the European chemical market is extremely soft. And you can see that not only in a basic petrochemical, but in different areas like the plastic recycling, which was expected to be a growth segment. Weak demand and high energy cost, feedstock, and competition from newer and cheaper capacity push margin really low. And from my head, I think in the last 2 years, we have closed 4 ethylene crackers in Europe. I think one in Gravenchon, ExxonMobil, one in Fife in Scotland, Versalis in Italy, and Sabic in the Netherlands. And the pressure is now extending into plastic recycling. Eastman Chemical Company has delayed its flagship chemical recycling project in Port Jérôme, while Virinor has already shut its Avonmouth facility after only 2 years of operation. So, to answer you very directly, the sector is clearly in phase of contraction, and we see more capacity being shut or mothballed than added.
Now, Baptiste, we really can't have a conversation today without talking about issues in the Middle East. Firstly, though, does Europe and the European chemical sector, does it receive oil and gas feedstock for its chemical production from the Middle East? And if so, the current conflict, will this have some kind of impact on the current pipeline of projects across Europe?
Yeah, Shaheen, you're right. Europe does import part of its oil and gas from the Middle East. Roughly, from my head, around 25%. It's a quarter. So we have some exposure, but it's much less dependent than Asia and far less than it used to be from the Russian gas. The main risk isn't that Europe runs out of supply. The main risk is prices. A lot of the world oil and LNG passes through that region. So if anything happened there, prices go up quickly. For European chemical producer, that's add pressure on top already of high in energy cost. Margin gets even more squeezed, and that's where we start to see projects being delayed, scaled back, or even cancelled. But it's not a new trend, Shaheen. We were talking about it back in August. It just speeded up. Europe is moving away from big commodity projects toward more specialized, lower carbon ones.
So, Baptiste, without secure supply of oil and gas coming out of the Middle East, obviously we're going to need to see a little bit more US LNG coming into the chemical sector. Is that supply still guaranteed? And more importantly, as you said, can it be obtained at the right price?
With US, it's not about supply, it's about cost, as you can guess. The US and others like Norway can cover European needs. But it's expensive and Europe has to compete with Asia, so it keeps things running, but gas stays costly. So that continued to shape the project pipeline.
Baptiste, over the last few years, much of the spending that you and your researchers have been tracking is associated with green chemical projects. What's the big policy framework in place that is shaping the decarbonization of the chemical sector?
Most of the investment in Europe right now is policy driven. And the main framework is the EU Fit for 55 package. It aims to cut emission by at least 55% by 2030 and reach climate neutrality by 2050. One key part of that is a refuel aviation, which is directly driving green hydrogen projects. From 2025, fuel suppliers at EU airport have to blend sustainable aviation fuel to their jet fuel, starting at 2%. It's rising to, I think, 20% by 2035 and up to 70% by 2050. Within that, synthetic fuels made from green hydrogen and capture CO2 become increasingly important, reaching around 35% by 2050. So green hydrogen, as you can guess, Shaheen, is a key enabler. And the industry was on track, if I remember, to meet the 2% target, but the final compliance data is still pending.
So Baptiste, maybe we could just inject a little bit of reality into all of this, though. Green projects typically higher cost. The end consumer may not be that willing to pay for the additional premium for green product. And obviously, we look at technologies. I mean, last time we had a conversation, there was a shortage of electrolyzers to make that green hydrogen, and the supply chains were a little uncertain. Are these still issues for green projects? Are we starting to see some of them stall? Are we saying, no, the pipeline's now wide open and we're seeing momentum? Or are projects still being pushed out? Which is it?
It's more subtle than that, Shaheen. We clearly see a wave of delays and cancellation in green hydrogen. As we already highlighted in our last podcast in August, we were tracking in this time around 800 projects. Only 6 months after, we track 700 projects. And in total, I think for the last 2 years, we have 180 projects that has been cancelled. So initially, many of those projects were focused on replacing gray hydrogen in refining or positioning hydrogen as a fuel on its own for power or mobility. What we are seeing now, it's not a full retreat. It's a burst of the bubble, as we mentioned. It's becoming much more selective and capitally shifting toward hydrogen derivatives and mainly as e-fuel because the demand is much stronger. That shift has been accelerated by policies like the ReFuelEU, which create guaranteed demand. As a result, we're seeing large-scale electrolyzer projects being scaled back or even cancelled, but smaller and more targeted projects being developed, and a stronger focus, of course, on e-fuel and synthetic aviation fuel. So overall, instead to have a rapid boom, like people were saying, what we see, it's more a ramp-up increasingly linked to e-fuel or to some extent the green ammonia for fertilizer.
So are you actually seeing any new trending sectors that are possibly showing more spending momentum than others? What are some of the new or the emerging spending hotspots?
Biomethane remains a very strong driver in Europe, and the trend is becoming even clearer. As we highlighted in our podcast last August, the CO2 capture from the biomethane process itself is as well gaining a big momentum, as e-fuel projects are being taken very seriously. I talk a lot with directors from major chemical companies, and there is a clear interest not only in the biomethane, but also in integrating the biogenic CO2 into applications like e-methanol or synthetic aviation fuel. Why I like particularly biomethane, it generates multiple revenue streams. In addition of renewable gas that can be injected into the grid or the CO2 into synthetic aviation fuel or e-methanol, we can use the digester as a fertilizer and return into agricultural land. This is a fast-moving sector. If I remember back in August, we were tracking around 300 projects worth $6 to $7 billion. And right now, 6 months after, we are tracking around 400 projects worth $8 to $9 billion.
Baptiste, where are you seeing new capacity still being planned from, I guess, either grassroots developments or indeed new unit additions?
We are seeing new capacity being planned both in grassroots and unit addition, mainly for e-fuel and particularly synthetic aviation fuel or e-methanol. That's largely driven by policies like ReFuelEU that we discussed earlier. Right now, we are tracking over 150 projects and more than 130 planned units, representing roughly around $30 billion in investment, and it's across e-methanol and synthetic aviation fuel. Around half is focusing on SAF, with most of the remainder in e-methanol, either for maritime fuel or as an intermediate for alcohol to jet fuel. And as we mentioned earlier, many of the large green hydrogen projects we initially saw are now being scaled down or refocused, with hydrogen increasingly directed to e-fuel production rather than standalone uses.
Now, Baptiste, we're coming into that key part of the year, the crop planting season. What is the outlook for European ag chemicals and in particular fertilizer spending?
The key things in Europe right now is that we are not running out of fertilizer. It's a story about how expensive it's getting. Because Europe relies heavily on imported energy, when something like the Strait of Hormuz is disrupted, prices here move very quickly. We can already see in the numbers, nitrogen fertilizer prices have jumped again and now really are well above pre-crisis level. That's why the Commission is stepping in to ease the pressure on farmers. Longer term, this should support investment in things like green ammonia, producing fertilizer locally using clean hydrogen instead of imported gas. But there is a catch. Shaheen, high electricity prices also make green hydrogen expensive, so it doesn't solve the problem just overnight. What it really does is shift the direction. Each crisis pushes Europe towards the same conclusion. Producing its own clean fuel and fertilizer isn't just about climate anymore. It's about security.
So that brings us to the conclusion of our podcast. A very big thanks to you, Baptiste, for sharing your insights and your perspective today. Thank you very much appreciated. And a very big thanks to all of you who tuned in. If any of you have any further questions about any of the discussion points that we raised today, then please do reach out to myself or Baptiste via the contact details that you can see here. All of the data and insights generated during our discussion are according to Industrial Info Resources data sourced from our Global Market Intelligence Project database. Thanks everyone for joining us. I hope we have helped you all better navigate some of those currents of change that we're seeing.